Here's the trap with HIMS and HERS. If you call it a GLP-1 stock, you may miss the company. If you call it a telehealth stock, you may also miss the company. The real question is whether HIMS can turn private, repeat, cash pay healthcare needs into a durable consumer health platform. So do not memorize this year's numbers. Use them as a case study. We are going to build a Proofgate checklist you can reuse on every future filing. Cash pay means the customer often pays directly instead of relying mainly on insurance reimbursement. That can make the business faster and more consumer-like, but it also makes pricing sensitivity much more important. HIMS is trying to build something very specific, a consumer health machine for private repeat cash pay healthcare needs. The machine is simple to describe, but hard to execute. Find a consumer who has a sensitive health problem. Make the first step easier than a normal doctor visit. Route that consumer through a digital intake. Put a licensed provider in the decision loop where clinical review is needed. Fulfill the product, ship it, keep the relationship, then over time expand from one condition into more of that person's healthcare life. That is the business, not the app, not the ad, not the GLP-1 headline. The business is repeat consumer demand moving through a clinical pharmacy fulfillment subscription and trust system. The reason this stock is so interesting is that both sides have real evidence. The bull case has real evidence. HIMS has millions of subscribers, more than $2 billion in annual revenue, positive cash flow, a visible consumer brand, and a model that can make awkward healthcare feel easier. The bear case also has real evidence. The baseline checkpoint showed gross margin pressure, weaker revenue per subscriber, a GAAP net loss, GLP-1 regulatory complexity, supplier power, and the risk that HIMS is buying growth through marketing instead of owning a durable moat. So this is not a simple hype video. By the end, you should understand 5 things: what HIMS actually does, how the company makes money, why the baseline financials look strong and weak at the same time, who the real competitors are, and the exact proof gates you can use on every future filing to decide whether HIMS is becoming a durable consumer health platform or just a very effective direct-to-consumer healthcare campaign. Start with the simplest question: what is HIMS and HERS? But here is where investors get tricked. A smooth customer experience does not automatically mean a strong business. HIMS and HERS is a consumer-facing health and wellness platform. It sells access to products and care workflows through websites and mobile apps. The categories include sexual health, hair loss, hormone health, dermatology, mental health, weight loss, and lab testing. For a beginner, the easiest way to understand HIMS is to compare it with the old healthcare path. In the old path, you notice a problem, you search online, you decide whether it is serious enough to book an appointment, you wait, you explain something personal in person. If medicine is appropriate, you go to a pharmacy, then you manage refills later. HIMS tries to compress that path. A customer lands on the HIMS platform, they choose a condition, they answer health questions. A provider reviews the case when clinical review is required. If the provider decides treatment is appropriate, a prescription can be issued. The product can be fulfilled through HIMS-owned pharmacies or partner pharmacies. Then the customer receives shipments on a cadence, often through a subscription. That word subscription is one of the keys to the stock. HIMS does not want one-time transactions. It wants repeat relationships. That is why the company focuses on conditions where treatment can be recurring. Hair loss does not usually get solved in 1 week. Sexual health medication may be repeat use. Dermatology treatment can require follow-up. Weight loss care can require ongoing monitoring. Hormone-related care can require a longer relationship. The dream version of HIMS is that one customer enters through one category and then uses the platform for multiple health needs over time. But the risky version is that one customer enters through an expensive ad, buys once, cancels, and disappears. That difference is everything. So here's the mental model for the company. Picture HIMS as a 3-part machine. The front pulls in attention, the middle converts attention into care, The back decides whether that care becomes profit. The front is advertising, search, social brand, and word of mouth. The middle is healthcare workflow, intake, provider review, prescriptions, pharmacy fulfillment, support, and follow-up. The back is economics, repeat revenue, gross margin, customer retention, and cash flow. If the top is strong, but the bottom is weak, HIMS is just renting customers. If the top is strong and the bottom gets stronger over time, HIMS becomes a platform. Now we have to be precise about the medical layer because this is where beginners often misunderstand the business. HIMS is not a hospital. It is not an insurance company. It is not a drug manufacturer. And in the US, it is not simply a corporation practicing medicine directly. The company uses arrangements with affiliated medical groups and providers. The providers retain clinical decision-making. HIMS provides the digital platform, administrative support, technology, billing support, customer service, and fulfillment infrastructure around the experience. That structure matters because healthcare is regulated differently from normal e-commerce. Selling a shirt online is one thing. Routing a patient through prescription care is another. The company has to manage provider rules, pharmacy rules, privacy rules, advertising rules, state-level healthcare rules, and medical trust. That is why HIMS can look like a consumer internet company on the surface, but the operating risk is healthcare risk underneath. Now follow the money. HIMS primarily generates revenue from online sales through its websites and mobile apps. That includes prescription products, non-prescription products, consultation services in certain contracts, post-consultation support where applicable, and lab testing where applicable. The important point is that this is mostly a direct consumer model. The consumer experience drives the business. The company also has some US wholesale revenue, but the official filing says wholesale revenue is not significant. Also, service revenue is less than 10% of consolidated revenue. That tells you something important. HIMS is not mainly monetizing long doctor visits. It is mainly monetizing the product and care workflow around online health offerings. For a beginner investor, every dollar of HIMS revenue needs 4 questions. First, how was the customer acquired? If the customer came through expensive paid marketing, the first order may not be very profitable. The company needs that customer to stay, repeat, or expand into more categories. Second, does the revenue recur? Subscription revenue is more valuable when customers keep renewing, but a subscription label alone is not magic. A customer can cancel, pause, or switch providers. Third, what is the gross margin? Gross margin means the percentage of revenue left after the direct cost of delivering the product or service. If HIMS sells something for $100 and the direct cost is $35, gross margin is about 65%. Higher gross margin gives the company more room to pay for marketing, technology, support, compliance, and profit. Fourth, does the customer relationship get deeper? If HIMS can serve one customer across hair, skin, sexual health, weight loss labs, and future categories, the customer becomes more valuable. If customers stay in one category for a short time, the business is much easier to copy. That is the first big idea. The stock is not just about revenue growth, it is about revenue quality. Now look at the numbers, but use them like a training example. At this checkpoint, the numbers looked like this. Full year 2025 showed real scale, about $235 billion of revenue, net income, positive adjusted EBITDA, and more than 2.5 million subscribers. Then the next checkpoint got messy. Q1 2026 still showed demand, but it also showed pressure. Revenue growth slowed, monthly revenue per average subscriber declined, gross margin fell, and the company reported a GAAP net loss. Do not memorize those numbers. In the next filing, replace them. The timeless pattern is what matters: revenue scale, subscriber quality, gross margin, customer acquisition, cash flow, and trust. That is the contradiction investors need to track. More subscribers can still be bad if each subscriber becomes less valuable. Positive cash flow can still sit beside a GAAP loss. Higher revenue guidance can still come with weaker profitability. This is why HIMS is a good deep dive stock and why the framework matters more than any single quarter. It can look bullish or bearish depending on which number you isolate. If you isolate revenue, the story can look strong. If you isolate net loss, the story can look ugly. If you isolate cash flow, the story can look more resilient. If you isolate gross margin, the story can look pressured. The correct read is not great or terrible. The correct read at that checkpoint was transition quarter, proof required. Now define two financial terms that matter here. GAAP net income is the official accounting profit or loss after expenses and accounting rules. Adjusted EBITDA is a management adjusted profitability metric. It can help show operating performance before certain costs, but it is not the same as clean net income. Adjusted EBITDA is useful, but it is also where management gets to remove some costs. Investors should not treat it like cash in the bank. That is why the baseline matters. HIMS could show positive adjusted EBITDA and still report a GAAP net loss. Both can be true. The investor question is whether adjusted profitability eventually turns into cleaner GAAP profitability. Cash flow is the other side of the story. At the baseline checkpoint, operating cash flow and free cash flow were positive. That gave the company real flexibility. Many growth companies with exciting narratives do not have that. But cash flow alone does not erase margin pressure. Marketing is the cost of feeding the funnel. HIMS can spend aggressively if each customer becomes valuable over time. But if customers churn quickly or move into lower margin categories, the marketing engine becomes less attractive. That is why retention is the hidden number behind the whole thesis. Now we have to talk about GLP-1, but again, think about the durable lesson. GLP-1 weight loss medications pulled HIMS into the center of a much bigger conversation. Weight loss is a huge consumer need, and HIMS had the exact front-end machine that could capture demand. Marketing, digital intake, provider review, and recurring care. But the lesson is bigger than one drug class. Every hot medical category creates the same test. Does it bring durable patients into the platform or temporary demand into the funnel? That lesson works for GLP-1, peptides, hormone therapy, dermatology, or any future category the company enters. The bull case is obvious. Weight loss can bring a large number of people into the platform. Once they are there, HIMS can potentially offer labs, follow-up, broader metabolic care, and future categories. In the best version of the story, GLP-1 is not the whole thesis. It is the front door. But the risk is equally obvious. GLP-1 is not just demand. It is demand with a rule book attached. GLP-1 is not a simple generic subscription that HIMS controls from end to end. It touches branded drug supply, manufacturer relationships, compounding rules, FDA policy, price sensitivity, customer affordability, and clinical trust. In 2026, HIMS shifted its U.S. weight loss offering toward access to branded GLP-1 medications and limited access to compounded GLP-1 products through the platform. The company also recorded restructuring and related charges tied to that U.S. weight loss shift. 2 years from now, the exact GLP-1 access model may look different, but the question will be the same. Does a hot category bring high-quality customers into the platform, or does it bring lower margin demand that disappears when the market changes? This is the key difference between hype and business quality. If compounded GLP-1 access was a temporary growth accelerant, then the market has to revalue the company around the next model. If branded GLP-1 access and broader weight loss care can keep customers inside the HIMS ecosystem, then the platform still has a strong path. The proof is not whether HIMS can attract GLP-1 demand. It already proved demand exists. The proof is whether HIMS can keep the relationship after the category becomes more regulated, more branded, more competitive, and potentially lower margin. That is why the baseline gross margin drop matters so much. Gross margin is where the GLP-1 pivot starts showing up in the economics. Now look at international expansion. At the baseline checkpoint, the US business was under pressure, while rest of world revenue was growing from a much smaller base. That kind of international growth can look explosive, but beginners should be careful. When a number starts small, the percentage growth can look huge. The better question is whether international revenue becomes a durable second engine. That brings us to Eucalyptus. HIMS announced an agreement to acquire Eucalyptus for up to $115 billion and completed the acquisition on June 2nd, 2026. Eucalyptus expands the company across Australia, Canada, Germany, Japan, and the United Kingdom. This is a major strategic move. The bull case is that HIMS is building a global consumer health platform while many digital health companies stay trapped in one market. The bear case is that healthcare does not scale internationally like normal software. Every market has different regulators, drug rules, pharmacy rules, provider rules, consumer behavior, and local trust dynamics. A digital playbook can travel, but it has to be rebuilt for each system. So Eucalyptus is not just an acquisition headline, it is a capital allocation test. Can HIMS integrate the business, grow internationally, keep customers, protect margins, and avoid turning the financial statements into a maze of earnouts, deferred payments, and integration costs? That is what investors need to watch in every post-acquisition update. Now competition, a weak HIMS analysis says HIMS competes with telehealth companies. That is too narrow. HIMS competes with anyone who can own the customer relationship for routine, recurring healthcare. There are 5 real competitive lanes. First, traditional healthcare. Doctors, clinics, specialists, and health systems still have trust. HIMS wins when the consumer wants speed, privacy, convenience, and a lower friction first step. Traditional care wins when the customer wants insurance coverage, in-person examination, specialist continuity, or a known clinician. Second, pharmacies and retailers. Pharmacies already touch prescriptions. Retailers already understand repeat consumer behavior. If they make digital access easier, they can pressure HIMS on price and convenience. Third, big technology and consumer platforms. Amazon One Medical's weight loss care page is a useful example. A giant consumer platform can combine distribution, payments, care access, and pharmacy relationships. HIMS has focus. Big platforms have scale. Fourth, specialty telehealth brands. There are many direct-to-consumer health companies that can attack one category at a time. A focused competitor can undercut pricing, outspend in one niche, or target the same digital ad channels. Fifth, drug manufacturers. This matters most in GLP-1. HIMS can own the consumer experience, but it does not own the molecule. If the branded drug manufacturer controls supply, pricing, and approved access, then HIMS has less leverage than it would have in a generic category. Now we can talk about the moat. A moat is the reason a company can defend profits against competitors. For HIMS, the weak moat is the website. Anyone can build a landing page, run ads, and create an intake form. The stronger moat is the system behind the website. Brand awareness in sensitive categories, a large subscriber base, provider network workflow, pharmacy fulfillment, customer support, data and personalization, subscription management, category expansion. Those pieces together are harder to copy than a web page, but they are still not an automatic moat. The moat becomes real only if it appears in the numbers. If marketing expense falls as a percentage of revenue while subscribers keep growing, the brand is getting stronger. If monthly revenue per average subscriber stabilizes or rises, customers are becoming more valuable. If gross margin recovers after the GLP-1 transition, the revenue quality is improving. If free cash flow stays positive while the company expands internationally, the model has room to breathe. If GAAP profitability improves, adjusted profitability becomes more credible. And if medical trust improves, the company can expand into more sensitive categories without breaking the brand. That trust point is not soft. In consumer health, trust is infrastructure. HIMS sells into categories where customers are vulnerable. Sexual health, weight loss, mental health, dermatology, hair loss, and hormone health are personal. Customers want privacy and speed, but they also need to believe the care is legitimate. If HIMS is perceived as a marketing company that touches medicine, the multiple should be lower. If HIMS is perceived as a trusted consumer health platform that can safely scale routine care, the multiple can be higher. That is the identity battle inside the stock. Now, valuation. This is the part of the video that ages fastest if we anchor too hard to one quote. The exact quote will be wrong someday. The process will not be. For beginners, a revenue multiple means investors are comparing the company's market value to its annual sales. It is not the same as a profit multiple. A high-quality dollar of revenue deserves more value than a low-quality dollar of revenue. Step 1, find the current market value. Step 2, compare it with the newest full-year revenue expectation. Step 3, ask whether the company deserves that multiple based on revenue quality, not just revenue size. That is why valuation depends on proof. If HIMS can grow revenue, stabilize gross margin, convert adjusted EBITDA into cleaner earnings, and keep cash flow positive, the market can keep treating it like a platform. If revenue grows but margin, churn, regulation, and legal complexity get worse, the market can lower the multiple even while the top line increases. This is why the stock is not solved by one chart. The question is not, is HIMS cheap at this quote? The question is, what quality of future revenue is the market already pricing in? Now, here's how to update this video later. If you are watching this 2 years later, open the latest 10K or 10Q and update 5 numbers. Revenue growth, gross margin. Monthly revenue per average subscriber, marketing as a percentage of revenue, free cash flow. If 3 or more are improving, the platform thesis is getting stronger. If 3 or more are weakening, the moat may not be forming. That is the whole point of the video. HIMS should not be judged by one old quarter. It should be judged by whether the machine improves over time. So here is the real test. Not whether HIMS can create demand. It already can. Not whether HIMS can tell a good story. It already does. The real test is whether the machine gets more efficient as it gets bigger. Now here is the final scorecard. Bucket 1 is customer quality. Start with monthly online revenue per average subscriber. At the baseline checkpoint, this declined. In future filings, if that number keeps falling, subscriber growth is less impressive. If it stabilizes, the platform story gets stronger. Then look at retention. Weight loss is valuable only if it creates durable relationships. It is dangerous if it creates expensive, price-sensitive customers who leave when the market changes. Then look at category expansion. The biggest bull case is not one product. It is the ability to serve the same customer across many recurring health needs. The filings need to show evidence that this is happening economically, not just strategically. Bucket 2 is economic quality. Start with gross margin. At the baseline checkpoint, gross margin fell. In any future filing, if that stabilizes and recovers, the platform story looks more manageable. If it keeps falling, revenue quality is weakening. Then watch marketing leverage. HIMS can spend heavily if customers have strong lifetime value, but if paid marketing remains the main engine forever, the moat is weaker. In every update, watch marketing expense as a percentage of revenue. Then watch GAAP earnings. Adjusted EBITDA was positive at the baseline checkpoint. But the company had a GAAP net loss. The thesis gets cleaner if adjusted profitability turns into real accounting profitability. Then watch free cash flow. Operating cash flow and free cash flow were positive at the baseline checkpoint. That was a real strength. The question is whether it stays true after the GLP-1 pivot and Eucalyptus integration. Bucket 3 is platform risk. First, clinical and regulatory trust, FDA policy, compounding rules, provider decisions, privacy, advertising, and medical quality all matter. Convenience without trust is not a durable healthcare platform. Second, international integration. Eucalyptus expanded the map. Over time, HIMS must prove that international growth adds leverage instead of complexity. Third, management discipline. HIMS has ambition that is useful. But investors need discipline, clear priorities, responsible acquisition integration, clean metrics, and no endless chase for the next headline category. So what is the verdict? HIMS is not just a GLP-1 trade. It is not just a telehealth story. It is a real consumer health platform trying to prove that convenience can become durable economics. The bull case is that HIMS has built a distribution and care machine for repeat consumer health needs. If that machine lowers friction, keeps customers, expands categories, protects margins, and earns trust, the company can become much larger than a weight loss headline. The bear case is that the machine depends too much on paid marketing, regulatory gray zones, supplier relationships, category hype, and customers who may not stay long enough to justify the acquisition cost. At this 2026 baseline, the honest answer is that HIMS belonged in the proof box. It has real scale, it has real demand, it has real cash flow. It also has real margin pressure, real regulatory complexity, and real questions about post-GLP-1 revenue quality. So what is the verdict? HIMS is not just a GLP-1 trade. It is a real consumer health platform trying to prove that convenience can become durable economics. HIMS is trying to turn healthcare convenience into a moat. Every future filing should be judged by the same question. Is that moat actually forming? This is educational research, not financial advice.